Welcome back to Retirement News Online. Well, the latest U.S. tax reform is offering some opportunities for farmers and ranchers, while at the same time maybe limited benefit for some producers. My guest here to talk about this is Scott Kaup, who practices in Stewart, Nebraska. Scott, let's begin by talking about some of the major changes that producers need to be aware of.
Well, some of the biggest changes have to do with the structure of a farm and the settlement and how it's arranged. We have one of the biggest changes in corporate taxes. Basically, for C corporations, the rate has changed to a flat 21%. But that it does mean for a farmer who is a C corporation as well as others, they actually have a tax increase on their first $50,000 of about $6,000. So that's one of the main ones. The other is that there's a change in the equipment purchase and the depreciation. We now have bonus depreciation available for both new and used purchases. Previously it was just new. And actually that was one of the things of the law that was made effective on September 27th, that you can take advantage of bonus on used going back to September 27th. The other thing on equipment that has changed is the expensing. The Section 179 limit has changed from $500,000 to $1 million. And possibly the biggest thing that everybody has heard about or should have is the Section 199A deduction, which is a 20% deduction of your net farm or ranch income that'll be applied to your taxable income. There are some limitations there, but those are the biggest. I guess the other one I forgot about is the exemption. The estate exemption limit has changed from 5.6 million per person to 11.2 million per person. This basically means a married couple now has a estate-free exemption up to 22.4 million. This is set to revert back to the old limit in 2026.
So Scott, it sounds like for a lot of producers, this is an opportunity to at least look at or consider possibly restructuring.
Potentially. The other thing that I think will be huge is for S-Corp. We're looking at a lot of our farmers, and Social Security tax is actually usually one of the biggest liabilities and one of the things we focus on. And so one of the things we're looking at is C Corp. Because the tax rate is higher, they might definitely want to look at an S Corp. We're also looking at some of our operations where we may have set up and they are operating as an individual Schedule F and paying rent to themselves, self-rental, over to say an LLC, and we've done that for Social Security savings. But one of the problems is now the amount paid over to the rental, at least we believe till we get IRS guidance, is not going to receive the 20% deduction. So we're actually recommending to all our farmers and ranchers, you have to look at your situation. Everybody's is individualized, but for some people it may be switching to an S Corp from either a C Corp or maybe more likely from being an individual farmer in order to have the Social Security savings and still get the 20% Section 199A deduction.
So Scott, I guess it's safe to say that tax planning at this level can be pretty complex. It's always a good idea to get professional help here, isn't it?
Oh, I think absolutely, and I think one of the things we're finding is that right now your taxes are changing because we're going through the year 2018, and I know a lot of advisors and people's accountants are probably not going to get the time to look at it till the end of the year, and it may be too late to make some of the changes to truly impact you. So this is definitely a huge change, and it's something that everyone, especially a businessman and a farmer and rancher, should be looking at their situation and getting professional advice as soon as they can.
Great, Scott. Thanks again.
You're welcome. It was my pleasure.
That's Scott Kaup with Kaup's Financial in Stewart, Nebraska, and thanks for watching Retirement News Online.